Technical indicators are the interpreters of the forex market. They look at price information and translate it into simple, easy-to-read signals that can help you determine when to buy and when to sell a currency pair. Technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. Each technical indicator provides unique information. You will find you naturally gravitate towards specific technical indicators based on your trading personality, but it is important to become familiar with all of the technical indicators at your disposal. You should also be aware of the one weakness associated with technical indicators. Because technical indicators look at historical price data, they do lag current market data to an extent, but they still provide excellent information. Technical indicators are divided into three categories: trending indicators, oscillating indicators, and volume indicators. In the forex market, information regarding volume is not available, so you only need to focus on trending indicators and oscillating indicators here. Let's start by looking at trending indicators. Trending indicators, like moving averages and Bollinger Bands, identify and follow the trend of a currency pair. Learning to interpret trending indicators can help improve your trading results because forex traders make the most money when currency pairs are trending. The first and most basic trending indicator is the moving average. Moving averages show you what direction a currency pair is going and where potential levels of support and resistance may be. Moving averages themselves can serve as both support and resistance. Moving averages are constructed by finding the average closing price of a currency pair at any given time and then plotting these points on a price chart. The result gives you a smooth line that follows the price movement of the currency pair. The next trending indicator is Bollinger Bands. Bollinger Bands can show you not only what direction a currency pair is going, but also how volatile the price movement of the currency pair is. Bollinger Bands consist of two bands, an upper band and a lower band, and a moving average, and are generally plotted on top of the price movement of the chart. Bollinger Bands are typically based on a 20-period moving average. This moving average runs through the middle of the two bands. The upper band is plotted 2 standard deviations above the 20-period moving average, and the lower band is plotted 2 standard deviations below the 20-period moving average. A standard deviation is a statistical term that measures how far various closing prices diverge from the average closing price. Therefore, 20-period Bollinger Bands tell you how wide or volatile the range of closing prices has been during the past 20 periods. The more volatile the currency pair, the wider the bands will be. The less volatile the currency pair, the narrower the bands will be. Let's now take a look at oscillating indicators. Oscillating indicators, like the Commodity Channel Index, or CCI, the Moving Average Convergence Divergence, or MACD, the Slow Stochastic, and the Relative Strength Index, or RSI, are indicators that move back and forth as currency pairs rise and fall. Oscillating indicators can help you determine how strong the current trend of a currency pair is and when that trend is in danger of losing momentum and turning around. While each oscillating indicator has a unique calculation, all oscillating indicators provide similar information. When an oscillating indicator moves too high, the currency pair is considered to be overbought, meaning too many people have bought the currency pair and there are not enough buyers left in the market to push the currency pair higher. This indicates the currency pair is at risk of losing momentum and turning around to move lower or sideways. When an oscillating indicator moves too low, the currency pair is considered to be oversold. This means too many people have sold the currency pair and there are not enough sellers left in the market to push the currency pair lower. This indicates the currency pair is at risk of losing momentum and turning around to move higher or sideways. You can see looking at charts containing the Commodity Channel Index, or CCI, the Moving Average Convergence Divergence, or MACD, the Slow Stochastic, or the Relative Strength Index, or RSI, that the oscillating indicators move up and down and up and down. Typically, you want to buy as these oscillating indicators turn around and start moving up off of their lows, and you want to sell as these oscillating indicators turn around and start moving down off of their highs. Of course, it will take some practice to learn how to identify these highs and lows, and they don't work every time, but you can put the odds in your favor as you trade using these oscillating indicators. Trading in the Forex market is all about obtaining and accurately processing the best information you have available to you. Technical indicators can help you do just that.